Good afternoon, at least at time of recording here. Have some investment thoughts and wanted to get them to you in a timely manner and thought a video like this might be the best way to go about that. We're starting to hear some of the concerns that investors have. You're opening your statements, you're going online. This is now the third month of market volatility after what was a very muted investment experience in 2021. And we know that it's very hard to avoid the headlines right now. It's Russia, Ukraine, it's inflation, Federal Reserve and interest rates, supply chain issues continuing, and now COVID cases rising overseas again. It's all just very heavy. So we want to make sure that we're able to provide for you our context, how we view this, the lens that we see it through, not to replace a phone call or a meeting with you, but certainly just to quickly get you the information that we think is best for you to have. So I'll start. Experiencing a period of losses, of course, is never comfortable. We know that you're seeing it, but we also know you've been here before. We're really not that far removed from the market drop at the onset of COVID-19 in March of 2020. We had close to a 20% market downturn at the end of 2018, and similarly close to 20% down at the beginning of 2016. So, really, that's three times in the last 6 years that you've had to go through that. It never feels good, but the market has always recovered to all time highs. Can't know exactly the path we're taking from here, but I think that context of patience is really key. So let the market digest some things. Your time horizon does matter. Diversification also matters. When we throw that word out there, we usually have the conversations with you around how much is in stocks, how much is in bonds. Really, we could get more granular. What types of stocks, what types of bonds? Here's where we are today. When we say the stock market, we could be talking about the Dow Jones down close to 8% year to date, the S&P 500 10% year to date, the Nasdaq down 17. But even bonds, the bond market, I'll use the ad index as the benchmark. It's down close to 5.5% year to date. These numbers move quickly as of right now. Think about that. For the Dow Jones, those 30 stocks to be down almost as much as bonds, really, I think is what's making diversification just not feel great right now. And certainly, if you're a conservative investor, if you identify that way by owning more bonds, it's illustrating that bond portion of your portfolio isn't really a great place to be hiding right now either. It's not feeling that way. So diversification matters. We're certainly going to stick to it, but that may be some of the problem that you're seeing right now, kind of getting losses on both sides of stocks and bonds. Third, just given the context on kind of where we are this year, we hit all-time highs on the S&P 500. That's the one I like to quote the most on January 3rd. That's just 10 weeks ago. And by January 27th, the S&P was down almost 10% already for the year. That was a very quick move for the market, but I also want you to think about what that means relative to the start of the Russian invasion of Ukraine, which happened on February 24th. That means the market has actually been positive since that date. And I think that's a really important context and very telling because it reminds us that what the market reacts to matters and when it reacts is really important, right? The market is always forward looking. We can and did at that time kind of attribute some of the January downturn uh, being the anticipated Federal Reserve rate hikes. So the market moved well before the rate hikes actually started. Similarly, the downturn in January can be attributed maybe to some of the concern, globally on what was going to happen before the fighting actually started. So it doesn't mean that there won't be pivots. Of course, there will be, but that may be why you hear the term sometimes or the terms, the market has already priced that in. It's because by the time you read the headline, the market has already moved. So I don't know if we are closer to a bottom or not. But again, I like that being the context that just because we're getting a headline every day doesn't mean that the market has not already priced certain things in. All that context aside, ultimately, I think the question that we're going to get or that we want to try to answer for you is where do we go from here? And while I have yet to find the crystal ball, um, I think you've probably heard us talk before about just wanting to have historical context. So I'll address where do we go from here in two parts. And the first is just to look back in history on how the market has moved in a similar situation. So, what is the situation right now? The question, could rising rates and inflation and supply chain issues really be enough to push us into a recession? That R word? The answer is sure. But I want to remember that, or remind you that the definition of recession is the decline in economic activity for two consecutive quarters. That's an economic term, it's not a market term. So, just as I was referencing a minute ago, markets have a tendency to move down before we're actually in recessions. And certainly they have the opportunity and have historically recovered well before we are technically out of a recession. So those moves can be sharp. But I go back to how important time horizon is. If your time frame is long enough and you follow our three bucket theory, you've got some cash reserve to work with. Does the timing of what's happening right now really affect you 3 to 5 years from now? We hope the answer to that is no, it really shouldn't. In fact, if you can be a buyer, that's a good thing. My key point there is I don't want you to be scared of that headline word recession. The second, where do we go from here, could be to answer that from the market perspective, right? Are we in for a bear market? Could that happen? Sure. But just as I said before, that's not abnormal, especially in the context of market shock events. So I'm thinking wars, conflicts, geopolitical events, anything that really wasn't a part of just a natural economic cycle. And I'll share this graph with you in an email. Historically, after those market shock events, pick one in history, where's the stock market gone after 3 months from that date, 6 months, 10 months? It's typically much higher if we're not near a recession. If we were near a recession, those losses on average 3 months, 6 months, 12 months after that shock event can be anywhere from -6% to -11%. Here's the point, we're already close to that 11%. So that's not to say that we can't go lower from here. Again, nobody knows. But it is to say that our recent experience is very normal. And after a bit of time, again, the market has always regained its footing. The second way to answer where do we go from here or what are we going to do about it would probably just to reiterate our investment philosophies for you, right? When we say diversification matters and how we allocate things, it's so that your does not perfectly match the experience that you're seeing in the headlines or the news. And we do not typically make large changes based on the market. We make large changes based on your life and your needs. So as long as your needs and goals haven't dramatically changed over the last 10 weeks, you're okay, right? We build these portfolios based on the history of the markets and know that ups and downs are going to happen. The data shows us that. We'll use math to build the portfolios to incorporate these types of downturns, like the scary markets, the times of loss, but also incorporate the good markets. So even when we say we know losses are going to happen and they're not fun, we can't know when, we can't know why, but that's okay. The point is diversification prepares us for those times. Our three bucket theory prepares us for those times. So, long story short, given everything that I think still needs to be digested by the markets, this is still a very short period of time. If your goals haven't changed, I know it may sound somewhat unsatisfactory, and I know emotionally it's maybe not what you want to hear, but I really can't think of any better advice than to stay the course. As of today, we want to stay the course. We want to continue to see how things are going to transpire over time. But history has taught us the lesson is always to avoid trying to time things. Do not let our gut, our politics, our worries, anything of that nature get in the way of us staying invested and staying diversified. So I hope that context helpful. If you have individual questions, let's be sure to spend some time together. Thanks.